Welcome to Pioneer Mindset, a place where we challenge our mindset and address the discomfort in both business and life by finding clarity resulting in bold conviction. I'm your host, Garrett Ruskamp, fifth generation farmer, husband, and father from rural Nebraska. Whether you're navigating frustration from past decisions or worry about the uncertainty you face today in your business, we're going to learn from our struggles and take on new challenges with a resilient mindset. Join me as I share my journey of struggles I faced in agriculture as a farmer and family man. I'm ready to dive into honest conversations to tackle the mindsets surrounding key issues that rural ag business owners face that will ultimately help you gain control, leading to a profitable and sustainable business. Let's adapt to Pioneer Mindset and get to it. Welcome back, everyone. For this week's episode, I want to talk about the 5 C's of credit. Now, before we dive into this, I think it's important to know why we're going to talk about the 5 C's of credit. So especially as we get ready to release this episode, we're going to be talking about generally that time frame where we're going to be going into the bank and renewing our line of credit, building that relationship back up. And especially this year, as we go into 2025, as we look at some pretty hard times in the ag economy, especially in the row crops, or just even in general, I think it's just good to keep this relationship with our banker good. And you're probably thinking, well, why do we need to know the 5 C's of credit? Because at the end of the day, that's our banker's problem, right? Well, no. At the end of the day, why we need to know this is so that way we can be good business owners. We can secure our financing, continue to do what we love, and reduce our stress, and ultimately, at the end of the day, take ownership and control of our situation. And that's what this is all about. Now, regardless if you're just getting ready to go into the bank for your line of credit renewal, or this is just always something that we need to keep an eye on, and this is always a work in progress. This isn't something that we dive into the last couple weeks before we go to renew our line of credit. This is something that needs to be done over time, and this is something that needs to be continually worked on. So as we got to diving into this, there's a lot to cover here, and there's 5 total things that we can cover and really dive into almost an episode on each one of those. But I think it's important as we dive into this to get a high level overview and what we can really focus on, try to make this practical so it's relatable to you as you're listening to this. So really think about your current situation. And as I talk about each one of these, where do you fall? What is your relationship like with your lender? What is your overall financial position like? So let's dive into this and get after it. All right. So the meat and potatoes here, we got the 5 C's of credit. We're going to cover basically, in short, we got character, capacity, capital, collateral, and conditions. All right. So we're going to start with the first one, character. That's exactly what it sounds like. A person's credit history and how they've managed debt in the past. That's a good way to look at that. But also your reputation. What is your reputation? And in some ways, that might be based off of you currently, but also your family in the past. Okay, that could be good or bad. If you've got a dad that banked at your current bank, even your granddad banked there, and they did really good. They always had good character, paid their loans on time, good relationship with the bank, good communication. That's going to portray well on you. That's going to be really good. But the opposite could be true as well. If you've got maybe a dad or granddad or somebody in your family that did not have a good relationship with them, that was not a good credit for the bank, did not keep up on their loans, did not communicate, did not know their numbers, that's going to portray onto you. And you're going to have to work probably twice as hard to build up that character and reputation for you. Now, another couple things here to consider is like your trustworthiness. Can you be trusted? Are you good with money? Are you good at building relationships, building strong community relationships? Are you professional? Are you willing to contribute to the community and not just take away from it? Okay, those are a couple things to remember there. But also being adaptable to adversity, and helping also there to be transparent. Be transparent and being open to communicate. Don't hide from your lender. Be open, honest, and also very proactive when it comes to the communication side of things. Demonstrate a very good personal and business integrity. Integrity there can be really big when it comes to the business side of things. Do what you say. Honestly, just do what you say. Hold to your word. Keep your word there. Make your payments on time. Manage your finances well. And just do your best to have a good relationship with your lender there. I think that's going to be a very good start when it comes to the character side of things. And honestly, this is just being a good, honest human being and business owner. Okay. Not just to really kind of sum that up in short. So that's character. That's the first one. Let's move on to capacity and cash flow. So when it comes to capacity, a person's ability to repay the loan. When it comes to getting financing, okay, we're going to be taking out a loan. We're going to be borrowing money. The bank wants to know, Can you repay this? Why does this matter? If you don't pay the cash back, this is not going to be a very good return on investment for this bank. They want to know whether their investment is going to be able to get paid back or not. Can you fully repay this loan? So then how is this assessed? How do banks actually go about discussing this or figuring this out? All right. So are you able to actually have financial organization? How well are you at knowing your numbers and borrowing and the repayment history that you've had in the past? They're definitely going to be looking at the past. Banks really love to look at trend analysis. Okay. Banks are pros when it comes to trend analysis because that's the data that they have. They can't necessarily look into the future. That's the unknown, but they're going to focus on the data that they have. So that's the capacity and cash flow that you've had within your operation in the past. So can you repayment? Can you make this repayment? Can you pay the loan back in full? All right. Another thing here is the overall profitability of the business. Are you a sound and consistently profitable business? What other sources of income do you have in the event that you need to help use those income streams to pay back your loan? And so for some cases, this might be a custom business, or maybe you've got a seed business on the side, or maybe you've got some sort of other side business. And to be completely honest here, when it comes to the banks, and they might also want to know what are the different income streams within your family. All right. So in most cases, if your wife has a town job or W-2 job, or just you personally, if you've got a W-2 job, they want to know what that amount is as well, because they're going to cover their basis. They're going to make sure that they've got plenty of income there to cover the loan in the event that the cash flow itself actually gets tight or even negative. They're going to make sure they're covering their basis there. And they're going to use, like I said, other sources of income to make that happen. Now, when it comes to the cash flow itself, are you monitoring your cash flow, and are you learning from your cash flow patterns? This is a big one here that I think we can really hit on is, are you actually learning from your cash flow patterns? Because we all have some sort of patterns or history or habits that we've seen in the past. Maybe we've been through farming. We've been farming for 10, 15, 20 years. We've got patterns. We've seen some things. We've tried to learn from them. Or I guess the question here is, are you learning from them? And are you able to adapt to that as well? Going back to the character side of things there. So when it comes to also the projections, as we get to putting in projections for, say, like this next year, are we regularly preparing our projections? Are we updating those on a consistent basis? Or is this something that we literally are just doing once a year, going to the banker's office, putting our projections together, letting him rather take care of the projections and put it into his or her hands? Are you letting them do that versus doing it yourself and updating those projections yourself? That way your projections are accurate. Because I've said this many times before, but nobody knows your operation better than you do. So you're going to have the most accurate projections versus just say letting them do it. Okay. But there, at the end of the day, it kind of comes into the cash flow that they have, that they're making their decision off of. So you want to be the most representation of your operation as possible. Okay. So when it comes to our cash flow, how do we master this? How do we master our cash flow? That's what we all want to know in these different C's here when it comes to credit here. How do we master this? All right. So first one there is going to be diversify your income streams. This produces stability. This kind of comes back to being diversified. There's a lot of operations that are diversified, and in most cases throughout the Midwest, people either have crops or livestock or of some sorts, whether it be cattle, hogs, dairy even, or whatever the case may be. But there's either diversified through crops or livestock, or diversified through custom work and your regular row crop or farming work, whatever that may be, just different income streams. Diversity streams, that really helps because when maybe one industry or one income stream is down, maybe the other one's up. And this can kind of really help produce stability. That's one thing the bank really wants to know. And that's how we can help master. That's one way to master that, is produce stability. But also improve your production efficiency. Improve your production efficiency. I think this is something that we're always really good at because it comes down to producing and day-to-day operations, is we can really see our efficiencies. And so it's really easy to tackle those. But the thing that's not always easy is the next thing that we can do to master this is eliminate unprofitable businesses. This is one thing when it comes to the cash flow that we need to be very mindful of, especially going back to the negative side of having different income streams and being diversified, is we tend to treat that as one income stream as far as at the end of the day, this is our operation. Okay. But we need to keep in mind, maybe if we've got different income streams, while that can be good to produce stability, if there's one of those income streams that's actually not profitable and that's actually sucking equity back out of their operation and not help building equity, that's going to be a negative. That's going to be taking us backwards. So we need to be mindful of that. So that way we're maybe eliminating that or cutting it out, or definitely not putting our focus into that income stream or that area there. So that's one thing to definitely keep in mind there. Now, next one here, how to master this, is risk management tools. A big one here, crop insurance. So as far as crop insurance goes, this is another way that we can help master our finances. And that's very easy on the row crop side of things because it's a tool that we can definitely utilize. But the thing that we can do within that tool is try to really manage that to the needs that we have. Let's say, especially this year when it gets into 2025, and say your break-even projections on corn or soybeans are negative, okay? Well, at the end of the day, we just need to utilize this risk tool as a mitigation tool. So let's maybe try to take out the most affordable crop insurance that we need. Let's maybe take out a little higher level to maybe just give us a little bit more peace of mind. This gives the bank peace of mind as well. So that's another way to help with your cash flow, is to mitigate that risk. And so especially when it comes to crop insurance, that's a good way to do that. On the livestock side of things, there's ways that we can do that as well. Or back even to the crops, we can do that with marketing, just forward futures contracts. And then back to livestock, there are different livestock insurance that we can take out. And so there's the LRP. And so there's different ways that we can manage that risk from a cash flow standpoint. So then the last one there is, how proactive are you managing your current debt? Are you really being mindful of what your current debt is and how you can manage that to make sure you can ultimately repay that at the end of the day? All right. So that was capacity and cash flow, 2 C's, but that's kind of really one there. The next one that we're going to hit on is going to be capital. Capital, a person's financial resources, such as cash reserves and even investments in a business, that ultimately are going to be kind of the capital that we used, that the banks get. That way we can really know what our capital position is. Money invested by the business owner. A borrower's ability to provide financial asset and capital to cover the loan to value set by banks. Now, I'm going to get into loan to value in a little bit, but also this is the number that we're talking about here when it comes to the borrowing power. How much can you actually borrow? Can you actually cover some of the different positions that you're trying to take? And to really keep this in mind, was we're trying to get yourself in a better position. The better position at your hand, the more willing that the bank is going to actually lend you that money, lend you that capital that you're trying to go after. All right. But the capital at the end of the day is, what do you have as a business owner? And there's the safety net or the equity. We can definitely keep that in mind, or the net worth. Those are different terms there that we could talk about when it comes to capital itself. But there's different types of capital. There's owner's equity. There's working capital. There's intermediate capital. There's fixed capital. Human capital, natural capital, and even social capital. I'm not going to dive into all those, but I think those are important just to remember each one of those. And each one of those has different values and how we figure those. Especially when it comes to working capital, that's a big one that the banks are going to really be keeping an eye on, because that's your ability to repay your debt. Your current assets minus your current liabilities equals your working capital. Very good number there to really keep an eye on. But also, capital could be, like I said, human capital. That's something you probably don't think about very often. Who is all involved in the operation? What are their skills and their resources alongside of social capital? You've always heard the phrase of, it's not what you know, but it's who you know. So that's another way to look at that when it comes to social capital. What are the current connections you have? What's the networks you're in? How can that serve you? How can that help you in a pinch, or just help you with your overall business itself? So definitely some things to keep in mind there when it comes to capital. Once again, how do we master capital? Well, invest your borrowing power, your capital wisely. Let's just be mindful as to where we're putting our money. Let's be mindful as to how we're investing that and what kind of investment we're going to get back from that. Also, make sure you have enough to take advantage when the opportunities that come up, or when the right opportunity comes up. That's the hard part there. Is a little side note, is we always have a hard time determining what is the right opportunity. Well, it's a lot harder to determine that when you don't actually have the capital there to actually capitalize on the opportunity. Okay. So make sure you have enough capital set aside, so that way when opportunities do come up, because they will over time, that's going to happen. They're going to come up. But let's set that aside. That way we have the right capital there when the right investment pops up. Also, another few reasons to keep your capital high, keep your capital built up there, is so that way the banks know you're protecting their investment as well. At the end of the day, they're investing into you, so they want to know that you're taking care of their investment. Another reason here to keep your capital high, kind of last one here on capital, is to maintain power and leverage over the bank. There's many, many reasons that we can actually maintain our power and leverage over the bank. But at the end of the day, it's going to be more beneficial for you and your operation if we can keep that capital high. Let's keep moving here. Let's get into collateral. Collateral is basically assets used to secure the loan. So if an asset is used to secure the loan, why do we care about it? We know we're going to pay this loan back. There's no question about it. We're going to be able to make this loan payments every month, every year. We're going to get this paid back. Why does the bank need this 80 acres or that tractor as collateral? The reason why is they want to know that they've got a backup source for if things go south. So that's a backup source for the bank. At the end of the day, they want to just protect themselves. That's what collateral is. The amount of collateral also determines the amount that you can borrow. The amount of collateral that is not borrowed out or basically has a lien against it already, the amount of collateral that we have available for the bank to use as collateral against the loan that you're trying to get. Now, how is this assessed? How is this all figured up? Well, higher collateral value and the lower the liabilities you have basically equals the more leverage and power that you have. All right, so the overall collateral evaluation, this is something that we need to keep in mind and just make sure it's accurate. Now, when it comes to evaluating our collateral, banks might do it a little bit differently than what we do or how a business owner should do it. And we need to be very mindful of this. So when it comes to building out your balance sheet, all of your assets and your liabilities, the assets are going to be used as collateral, right? That's what we're discussing. But we need to make sure that we have the evaluation of these assets. You could have fair market value, you could have current value, you could have the value of when you paid for it or when you purchased it. All of these could be in consideration, but at the end of the day, we need to make sure it's accurate to date. So one thing here in the current market that I've been thinking about here lately is really when it comes down to the collateral of, say, equipment. Okay, so our equipment values have really declined, especially into the second half of 2024. And so this is a big thing that's going to be updated when it comes to talking with your bank. So let's make sure these collateral values are actually current and accurate and really up to date, because at the end of the day, this is going to affect your overall borrowing power with that bank. So that's something that we really need to be mindful of if there's big fluctuations in the different evaluations of our assets. Now, same could be true for land or real estate or an asset that you have there. If that's really appreciated, that's something to keep in mind as well. And we can definitely increase that evaluation of that asset. That's going to make our position look better, have more power. And that's important to do, but we need to be mindful of that, because if that's something that's only appreciated with, say, the appreciation of land itself, versus when we paid for it. So we need to be maybe a little bit more mindful as the number that we're putting in there, maybe a little bit more conservative, not always literally every month. Oh, looks like this land down the road sold for $15,000 an acre. Let's increase our land to that on our balance sheet. So that way it makes our position look a lot better. Well, let's just be mindful of, is that serving us? Is that serving us as a business owner to make that increase in the evaluation of our land? Or would it be better if we actually kept it a little bit lower? Held our feet to the fire, make sure that we're being responsible with our assets, to make sure that we're really being mindful of that, because it's going to be a lot harder to take that down if things depreciate and actually come down. So just be mindful of that, but also just make sure that they're as accurate as possible. Another couple things to keep in mind here when it comes to collateral evaluation is any liens that might be out there. When it comes to, say, if you've got a piece of asset that's collateralized already, and who's got the first lien on that? Is this already used as collateral, so we can't use it over here as collateral as well? You can't double collateralize that. And also another thing here is insurance to protect the value of these assets. This is a good example here. When it comes to your current assets, if you're going to be going to the bank to get a line of credit, which is generally used to produce or grow your crops or borrow, or even the livestock that you're growing, if that's going to be used to purchase that or kind of help grow that, the line of credit is going to need collateral against that as well. Anything that you borrow money against has to have something to secure that loan. So sometimes people are using the crops themselves or the cattle themselves as collateral. The bank is going to want to know that the value of those is protected. That kind of goes back to risk mitigation when it comes to the cash flow. But this importantly is just for the collateral side of things. That's why banks are making sure that you are taking out crop insurance. And they want to know what your actual coverage level is as well. They really want to know the specifics of this if they're a good enough bank, so that the way they're doing their due diligence to make sure they have enough value of that asset, so that way it's going to be covered. Like I said, the collateral, and this also kind of goes back to cash flow, but just a couple things to kind of keep in mind there. And are you protecting yourselves, like from crops and from the cattle side of things, to make sure that the collateral that they have, that value is protected? Now, let's also get into the value assessment of these things. The loan to value ratio. Are you familiar with this term? Loan to value, think about this in your head. Have you ever heard this? Essentially what this means is how much the bank is willing to lend out based on the value of that collateral. This is different for each different asset that we have. So for cash, they're willing to basically consider that loan to value is 100%. So this is on a percentage basis here. So how do we figure what the loan to value is, or how much they're willing to loan out against that asset? Well, it's based off of volatility. It's based off of liquidity, and also even like store value. And so store value also kind of goes back to the volatility. So from an asset standpoint, we've got current assets, intermediate assets, and even long-term assets. Generally, current assets are pretty volatile. That's your crops. That's anything that you have in inventory right now, okay, besides cash. So, your loan to value on those could be 70, 75%. They're just going to make sure that they've got their bases covered there. So that way, in the event that devaluized or that goes backwards, that they're covering their bases there. Same thing for equipment. That's usually going to be 70, 75% that they're willing to loan out against, okay? So if you got a tractor that's worth $100,000, 75% of that's what they're willing to loan out against. Okay, so that goes back to 75%. 75,000 is what they're going to actually consider as collateral. They're not going to value that at 100,000, even though that's what your current market value is. They're going to take into consideration that they need to keep their bank safety net in consideration as well. So that's why real estate is a pretty good store value. That's why real estate has just generally gone up in value. It's really appreciated. So that's why they really keep in mind that's maybe more like an 80%. So a good way to remember here, like I said, this is getting kind of long, but I think it's important to cover, is when it comes to real estate, when you go to the bank and you want to buy this 80 acres, say it's worth 800,000, or let's use $1 million for easy numbers here, but you got to put 20% down. Why do you have to put 20% down? Well, it's because they're only willing to loan you out 80% of that. Okay, so the 20% is basically that safety net that the banks have. So back to this, how do we value this? Well, it's different, like I said, between the current, intermediate, and long term. It's one thing to really keep in mind here. Now, how do we master this? One thing to really consider, how do we master this? Well, don't be careless. It's kind of stating the obvious here, but don't be careless. But also, really update your values often. Update your values often. This is why it's very important for us to have a way to track our balance sheet, way to track all of our assets and liabilities on our own. We're not relying on the bank. We're able to go in there and update these on a consistent basis. Know what your values are, know what your borrowing power is and how it's calculated. The borrowing power is basically your ability to borrow against everything that you have as an asset, everything that the bank can use as collateral. So it's very important here to know this. And also, if you're utilizing different lending institutions, maybe use John Deere Financial, maybe use this bank for your operating line, maybe use this bank for your real estate. That's 3 different lending institutions. You could have different collateral for each one of those and different borrowing power for each one of those. So we really need to be considerate of that as well. Let's keep moving here. Last C here is conditions. Conditions. What are the conditions of this transaction that the bank is going to be loaning you to? Giving this loan to you so that way you can go operate. What is the conditions here? Basically the terms of the loan and the economic factors. What is the state of the business? Is your business struggling? Are you consistent? Are you consistently profitable? Are you consistently negative? Are you growing? What is the state of your business? And also, when it comes to the funds, what are the funds used for that you're trying to basically get this cash for? What are you going to be using it for? They really need to know. Is it just used to buy this toy or maybe a boat? Or are you going to be using it for something that's actually going to have a really good return on investment? They also need to keep in mind what is the state of the economy and the overall industry, especially the ag industry. And that's a big one here when it comes to focusing on this next year. If you want to try to get any sort of financing, what are the funds going to be used for? And because of the industry that we're in right now is looking pretty tight, pretty negative. So that's a couple things to really consider there. And this all kind of comes back to how do we master this? Well, be smart, track your numbers, create good open communication, and show the bank that you are a sound and good investment. At the end of the day, we're trying to market something here. We're trying to market you, your operation, your financing needs. You want to do the best that you can present all of this information, the 5 C's of credit, to your bank. At the end of the day, this is just going to be a way to present yourself as a good grade A customer to the bank. So, like I mentioned before, that you can secure financing for the thing that you love to do and reduce your stress, continue to farm on. I really hope that you follow along. I know this is a long episode, but there's a lot of things that I can help you with here. If you're struggling in any way that you've maybe followed along and say, hey, I'm good with this, but not that, I could probably use some help. I could probably use somebody to help keep me accountable in these different areas so we can keep our asset values updated or our cash flow updated to make sure that we're staying in good relationship with our banker that helps the credit overall, helps us really just do what we want to do in business. So I really hope this makes sense with you. I really hope you've found value in this. But for now, that's all I've got on the 5 Seeds of Credit, and we will catch you next time. Thanks for tagging along with me today as we sharpened our mindsets. If you've gained insight from today's episode, be sure to take a screenshot to share or send this episode to somebody who might also find value in it. For more, follow me on Instagram @GarrettRuskamp or on Facebook, and join me next time for more conviction through clarity.